Moving averages help traders see the big picture by smoothing out price fluctuations. Instead of reacting to every spike or dip, you use MAs to understand the overall trend direction. Let's break it down. What is a moving average? A moving average is simply the average closing price of an asset over a certain period. This average is plotted as a line across the chart, forming what many traders call the trend line. Think of it as a road. It shows you where the market is going, cutting through all the noise. There are many types of MAs, but two are used most often: the simple moving average, or SMA, and the exponential moving average, or EMA. Simple moving average. The SMA gives equal weight to each price point. It's smooth and steady, perfect for identifying long-term trends, but it reacts slowly to sudden price changes. Exponential moving average. The EMA, on the other hand, gives more weight to recent prices. It reacts faster, making it great for short-term trading in volatile markets. However, this speed can lead to more false signals. Quick comparison. SMA is best for patience and confirmation. EMA is best for speed and early entries. Choose the one that fits your style. How to use SMA and EMA. Let's look at two practical ways to apply them in real trading. Use case 1, SMA 200 to spot trend. Imagine you're looking at the daily chart of gold XAU/USD. You add a 200-day simple moving average to the chart. If price is above SMA 200, it's a bullish trend. If price is below SMA 200, it's bearish. This helps you trade with the trend, not against it. Use case 2, EMA 9 and 21 for entry. Now switch to a 1-hour chart of BTC/USD. You add EMA 9 and EMA 21. If EMA 9 crosses above EMA 21, that's a buy signal. If it crosses below, that's a sell signal. This crossover method is popular with day traders. Risk management tip: always set a stop loss below the last support and define your take profit at the next resistance or with a fixed risk-to-reward ratio. Common mistakes. Here are 3 common mistakes to avoid. 1. Ignoring the major trend, like buying below the SMA 200, when the long-term trend is clearly down. 2. Trusting crossovers blindly, without confirmation from other indicators. 3. Using the wrong settings for your time frame. This can make your signals too fast or too slow. To wrap it up, use SMA for long-term trend direction, use EMA for faster entry signals, and most importantly, combine MAs with other tools to boost your accuracy.